Welcome to this second video in the Walk the Walk with You series, Facts of Financial Assessment. The goal of this video is to familiarize you with the kinds of information and legal requirements that you'll need to be fluent in when preparing reverse mortgage financial assessments. If you have prepared regular mortgages previously, these will be very familiar to you. What is the purpose of a financial assessment? Fundamentally, you want to ensure a smooth process that is successful both for you and your client during the application process. This is an honest appraisal of whether or not a reverse mortgage is a good option for your client. At this stage, you can look into your client's past as well as look forward into their financial future. Effective income is considered legally derived and properly reported on the borrower's tax returns. Start with the basic acceptable income documentation, i.e. Social Security and/or pension, and determine if the borrower will meet the willingness and capacity test based on the residual income table. Negative income should be deducted from the borrower's gross income and not treated as a reoccurring monthly liability. Income documentation is a history and verification step. It is also a common sense step to avoid surprises in the process. Be aware of what to provide. Social Security or disability provide one current month bank statement in lieu of a pay stub or award letter of benefit. Provide letter of explanation from borrower of any gaps of employment. Minimum continuance of income 3 years from date of case assignment for all income sources. Complete tax returns for prior 2 years with the signed 4506T may be required and provide the easiest way to document several types of income such as rental, interest, dividend, or annuity. Self-employment is defined as 25% or greater ownership in a business, and verbal re-verification of employment is required within 10 days of closing. Download the First Reverse Income Matrix tool to assist with documentation. The lender is to establish the borrower's willingness, as demonstrated on a tri-merged or RMCR report, as defined by HUD, to meet their financial obligations in a timely manner, including property charges. Credit scores are not required. If the borrower had difficulty making payments or is reflecting late pay history, obtain a detailed letter of explanation with supporting documentation of the event or extenuating circumstance. Cumulative balances for collections of $2,000 or greater will require full payment or evidence of payment arrangements, or 5% of the balance included in total debt calculations on the cash flow analysis. Being clear in this area is critical. All housing and installments on time for the prior 12 months and no more than 230 late day payments in the prior 24 months, and no major derogatory credit or revolving debt in the prior 12 months. This subject isn't absolutely clear-cut. Use your best judgment. Unacceptable credit is an apparent disregard for financial obligations or inability to manage debt. However, before proceeding to a denial, determine if the borrower experienced an extenuating circumstance beyond their control that caused the problem, such as these. If unable to support extenuating circumstance, a fully or partially funded life expectancy set-aside, also known as a LISA, may be required by underwriting. Unacceptable credit, where do you go from here? Provide a detailed letter of explanation from the borrower explaining the circumstance causing the derogatory credit. Provide supporting documentation of the event. Establish an isolated time frame for the event, or submit evidence the borrower's event is not likely to recur. Has the borrower shown they have reestablished credit since the event? Was the event supported with documentation? This will be evaluated by an underwriting team. Lenders must establish a 24-month satisfactory history of all property taxes showing no arrearage or delinquency. All listed property charges below require a 24-month history, except for insurance. Homeowners and flood insurance require a 12-month history to support no lapse of coverage. Make sure to establish accurate information about costs to the property. Various insurance and fees will need to be included in the process for a fair assessment. For assistance with this, you can download the First Reverse Credit Matrix tool. Let's take a look at figuring out the gross living area, also known as the GLA. The GLA is defined as the total square footage that is habitable. The GLA is multiplied by a value of 14 cents. That figure equals the monthly maintenance cost. This factor of 14 cents per square foot is established by HUD to estimate the cost of average home maintenance. Let's take a look at cash flow and residual income. This is included in the HECM Financial Assessment Worksheet. It is quite simple. You take the borrower's monthly income and subtract the monthly property charges, the recurring monthly liabilities credit, the income tax FICA on taxable income, and the maintenance calculation. The big question is, when do I document extenuating circumstances? These are the 4 areas. Derogatory credit is not an automatic denial. You simply need to document extenuating circumstances. If you're unable to document, underwriting will evaluate the loan for a life expectancy set-aside called a LISA. Examples of extenuating circumstances include loss of income due to death of a spouse, income loss outside of the borrower's control, such as a layoff or job elimination, medical emergency or hospitalization, or an act of God or accident where there was an increase in obligations due to a flood, hurricane, fire, etc. Establish a timeline supporting a direct cause for the late derogatory pay history. Documentation can be done with common sense types of things that would accompany any of those unfortunate events. Evidence supporting that the borrower didn't have an unwillingness to pay or meet their obligations is encouraged. When do we need to establish compensating factors? When the borrowers meet willingness but lack capacity to pay. Where residential income is insufficient based on the table established by HUD based on family size and region after evaluation of monthly cash flow. When a borrower has acceptable credit and no property charge delinquencies over the past 24 months. See our documentation for details. Examples of compensating factors include where the borrower has strong, verifiable asset reserves, not used in asset dissipation or not included in residual income, or additional income that may be documented properly. This can include NBS or household member not on loan but willing to provide, overtime, bonus, part-time, seasonal income for less than required 2 years, but received a minimum of 6 months and established is likely to continue, monthly distribution of income from HECM proceeds. Questions to ask if borrower doesn't meet capacity residual requirements reflected on the cash flow assessment. Do you have additional income from other sources, household members, NBS that are willing to provide documentation? Do you have additional assets available that could be documented to support reserves? This may include the structure of the HECM loan. Do you have additional assets that could be documented to add income through asset dissipation, such as projected income from the assets? A fully funded life expectancy set-aside, or LISA, may be an option for a borrower that does not meet a willingness acceptable credit guideline for financial assessment. If a lender requires a fully funded or partial LISA, the borrower cannot request a cancellation after closing. This may be a means of making a HECM loan beneficial to the borrower to improve their current situation. A fully funded LISA will hold the following property charges: property tax, homeowner's insurance, flood if applicable for the estimated life expectancy of the youngest borrower, which will also include a factor to allow for increases. The lender will make payments directly to the taxing authority, insurance, etc. A partially funded LISA would be available if the borrower has acceptable credit, established willingness, but lack of capacity to meet their obligations. The borrower receives 2 semi-annual payments to pay these items themselves. Calculations are based on the residual shortfall. A fully funded LISA may be required if the partially funded LISA set-aside is greater than 75% of the projected charges. Thank you for participating in the Walk with You through financial assessment. If you have any questions, please click on the FAQ link on this page.